Welcome to Turning Hard Times into Good Times. I am your host, Jay Taylor, and I'm speaking to you on December the 6th, 2016. I am also the author of a newsletter, Jay Taylor's Gold, Energy, and Tech Stocks, and my company, Taylor 100 Money Advisors, is in partnership with Chen Lin, who publishes What is Chen Buying, What is Chen Selling. You can subscribe to either of those newsletters by going to miningstocks.com or calling our office in New York at 718-457-1426, 718-457-1426. I want to thank each of you for listening to this show, making it one of the more popular shows on the Voice America Business Channel. Also, feel free to send along your questions, comments, criticisms, and praises to questionsfortaylor@gmail.com. I do want to thank our sponsors for making this show economically viable. Today's show is sponsored by Novo Resources, Klondike Gold, RN Resources, and Ariane Phosphate. And we'll be talking to Ivan Bebek, the chairman of RN Resources, in a few minutes. And next week, Quinton Henning of Novo Resources will be a guest on this show. I've titled today's show, Will a Trump Presidency Unleash Hyperinflation? John Williams, Ivan Bebek, and Michael Oliver are returning guests today. Economist John Williams of Shadowstat's newsletter fame is known for his honest employment numbers and inflation statistics, and that those contrast very sharply with those of the United States government stats. For example, if we use the same yardstick that was used for inflation going back before Ronald Reagan, John reckons we'd be looking at 7 or 8% cost of living numbers rather than the 2% metric that is widely talked about by the mainstream media. Likewise, if we'd gone back to the same measurement that was used in the 1930s, we'd be looking at unemployment rates that are closer to 20% than the sub 5% range that they're talking about these days. In other words, according to John's work, we learn that things may not be nearly as rosy as President Obama and President Bush before him would have us believe they are. In recent years, John has warned of an inevitable hyperinflationary depression, given upwards to $200 trillion of federal debt on balance sheet as well as off balance sheet. And John points out that can only be repaid by printing press money. So far, mountains of debt have really slowed economic growth, keeping the inflation numbers down, or perhaps we're really seeing inflation, but they're in the financial markets. But according to John, that's going to change, and it's going to change very dramatically. So we're going to listen to what John has to say about that topic, and perhaps have him reflect on a Trump presidency and what that might mean, if it might accelerate his view of impending inflation, or just how does he see a Trump presidency proceeding with respect to the markets and gold as well. John is also very, very bullish on gold. In just a few minutes after our first commercial break, I will be talking to Ivan Bebek, and RN Resources is really one of my favorite junior gold mining stocks. And Ivan will talk to me about not one, but two or three, actually 3 or 4 targets that they have, exploration projects. All 3 or 4 of them have tremendous upside potential to become world-class deposits, and they've had tremendous track record in the past. Bebek and his partner have had 2 major successes. We had one here. Caden Resources was a sponsor of this show. We've had Ivan on to talk about that. Last year, when all the gold shares were doing horribly, they sold that to Agnico Eagle and made their shareholders a ton of money. So a good track record, all the right things in place. We're looking forward to talking to Ivan right after our first commercial break. But right now, we have Michael Oliver with us once again. Thanks for joining me again, Michael.
Glad to be back, Jay.
Always good to talk to you, and it's always important to tell our listeners that your website is olivermsa.com, olivermsa.com. Well, Michael, in an email you sent to me yesterday, you mentioned that the most important market movement, perhaps yesterday, was that of the euro. The euro moved up very dramatically against the dollar. Talk to us about the significance of the sharp rise in the value of the euro yesterday, and that came right after a surprising, an important election result in Italy.
Mm-hmm. The euro was down near 105 against the dollar, and it shot up to 108. So it's a sharp one-day intraday plunge and then recovery. It's stabilized between 107 and 108 now. The big issue on the euro and the dollar index, which is a basket of trade-weighted currencies, is that the euro is 57% of the dollar index. So it's like, the Dow Jones with one stock that's 57% of it. So the dollar index really is a mirror of the euro. Okay,
sure.
Given that. They have been the dullest, most sedate markets this past year, and they've been the dullest, most sedate in their history. You get a 20, 30-year chart of the dollar index, or you go back to the euro, and find me periods of time where you have 12, 13, 15 months of absolute sleepwalking. And that's what you've had. You've had such narrow ranges. So while the world has been shaken up to some extent, especially the debt markets recently, the gold market this year, the rise in oil, we've had volatility elsewhere, but not in this key, huge asset category. Forget about minor currencies. The two biggest currencies in the world are dull. They will not stay that way. Our work suggests that if the dollar index, which recently poked its little nose out above 100, which it had hit last year and again this year, it went up to 102. We had anticipated that it might probe above the high. Why? Because chartists like to do that. They see it's like a target. You want to throw a brick through it, see what happens. So they went up to 102, and nothing happened. It backed off to about 100 again. Our work suggests that if the dollar index, which is now barely above 100, which is where it was almost 2 years ago, drops back to 98 to 98.5 anytime next year, it's over. You're breaking an 11-year momentum uptrend line on annual momentum. Euro, the reverse of that. If next year, which is how many trading days away, you trade the nearby euro futures up to 108, which is like yesterday's high. I break the annual momentum out to the upside. So what I'm arguing is that this asset category, which is so pivotal to a lot of other markets, the impact, they were going to come alive next year. And I strongly suspect that what it's going to be is dollar down, euro up, and the dollar down is going to help further encourage the rally that's already underway in commodities, which is a mixed rally at the present time. This year it was gold, oil, copper to some extent, sugar, and silver. Next year it's going to be the food commodities, particularly will take the stage, especially stress the grains. So the Bloomberg Commodity Index, which is a good balanced metric to look at the commodity markets, is already in a bull trend in our opinion. It emerged in October's close. It was 84.5. It's now up around 88. We think it could surge well over 100 rapidly, 110 area, just as a first surge. That's a big percent move. And we think next year the large contributor to that will be grains. Well, if this 4X situation does increase in volatility and change the trend, which we think will happen, dollar down, euro up, that should have an impact that's like wind at the back of the commodity upturn. So that's what we're watching right now, is more than what's gold doing. I'm watching that euro, because if that euro is hanging around yesterday's high anytime next year, it's out of here.
Anytime next year.
Yeah,
so, I mean, the probability at some point that you would get a reading of 98 to 98.5 on the index.
On the dollar.
The dollar on the index would, I mean, it seems highly likely that you will, right?
It's a 2%
at some point.
sneeze. A 2% dip, and it breaks it. And this is you don't see it on a price chart. You have to go to annual momentum, which is we focus on momentum trends as opposed to price. If you look at price, 98 doesn't mean a thing. It didn't break anything. We've been down in the 93s this year. But when you look at an annual momentum oscillator, if you drop down to that level next year, I'm going to blow a trend line that's got like 5 points on it that goes back to 2005. So it's a huge momentum uptrend structure that will go negative if the dollar index sneezes next year.
Wow.
Below 2% below where it is right now. So that's how potent the 4X markets are in terms of, one, coming back to life, and two, putting wind in the sails of commodities.
All right, let's suppose that happens. What do you see as sort of a likely downside for the dollar on the index?
That's a good question. I can't give you a good answer right now on that, but okay. Large. I have not done the homework that necessary to answer that question.
We'll save that question for another time then. Quickly, with a couple of minutes left yet, actually 1 minute, what about gold right now? Then I guess it's the mirror image to a certain extent of the dollar index.
Yeah, I think gold is trying to put in a bottom here. The gold miners, which is our stress point. We like them the best. We said that last year. We said that in February when they broke out. In fact, the gold miners have not even pulled back to where our buy signal was. GDX index, for example, GDX ETF is 21.5 area. We had a buy at 15.5 to 16. Now, gold has come all the way back down almost to our February buy levels, which is in the 1160 to 1140 zone. So gold has been weaker in this pullback than GDX, and GDX is holding up a lot better. Miners are, on a percent basis. They're up nicely from our entry point, and they're up massively from last year's low, which was down in the 12s, as I recall. So I think that especially if the foreign exchange situation shifts in January, with the numbers I threw out there, that's likely to put also some life back in the gold market.
Right. Well, I would like to just mention that, Michael, you're looking at all of these different markets, and you sort of look at, understanding the interrelationship of these various markets. I mean, you've been talking about the likelihood. I mean, you look at the markets, at each of these markets separately. So, for example, your momentum work started suggesting that equities and bonds were getting long in the tooth, and we were getting very close to, structurally, to a breakdown in those markets. We haven't seen it yet in the S&P. We certainly, seems as though we've seen it in the T-bond. And now we've started to see it in gold and some of the commodities to a certain extent. So I guess you look at these markets individually, but you also looked at them sort of from a bigger picture collectively, how they fit together, right?
I think it's essential you do that, and that's why I think this Forex situation is a neat mystery, because it's been so sedate, it's so quiet, it's like a time bomb. And when you go back in history, and I've done this before in a lot of reports on the dollar. In fact, we were bullish on the dollar when it was in the 70s. Back in 2011, it was trading in the dollar index was in the 70s, and our target, frankly, was 100. And it was in a period then of extremely sedate action, off-the-chart sedate. And we knew it wouldn't last, and sure enough it didn't, and it also translated not into downside volatility, but upside in price. This time I think it's the opposite. We have sedateness in the dollar at high levels, sedateness in euro at very low levels, and we think that will reverse. We'll get both volatility in both and trend change. Yeah. And that should impact all the other asset categories.
It's fascinating stuff, Michael, and also I can't emphasize enough how accurate your momentum work has been relative to price work that many analysts do. So I want to thank you very much for coming on the show again. Folks, it's OliverMSA.com, OliverMSA.com. Thanks so much for being with us, Michael, and hopefully we can do it again next week.
Thank you, Joe.